This is CPA Berkeley video series. Today we are going to discuss Unit 2, 3 and 4 for BECC, that is Business Environment and Concepts. Broadly we are going to discuss the macroeconomics and globalization topics in detail. We will start our discussion from microeconomics, which is considered to be a study of individuals. Opposite to this, we are going to discuss the macroeconomics, which is the study of the firms. And in the last, we are going to discuss the globalization issues which are affecting business in general. We will start our discussion from demand, supply and equilibrium, which is the basic topics. Demand is anything which is in the economy is surely dependent on demand and supply forces. In demand, we have to discuss that demand is for some specific product which is backed by the purchasing power. We will discuss the law of demand, which says that there is an inverse relation between price and quantity. As the price goes up, demand goes down. We will show it by a curve, which is a downward slope curve. By using a table, we can see the figures that once we will see the effects of increase in price, surely it is going to affect the demand as a decrease. This is a general mechanism of price and demand, which is usually known as law of demand. And in the extension, we have to discuss the supply law. This shows there is a direct relation between price and supply. As the price goes up, supply goes up also. So there is a direct relation between price and supply, and it is shown by the upward slope curve. How the prices are settled. This is where the demand curve intersects the supply curve. It's a point called equilibrium, and this is also called as a mechanism for settling the price in the economy. Then we are going to discuss the elasticity. Elasticity is the degree of responsiveness between changes in, if we are talking about demand elasticity, then it's a degree of responsiveness in the quantity demanded with respect to the price. Generally, elasticity has three choices, three behaviors. One is the price elasticity, when we see the responsiveness of the quantity demanded with respect to the price. This is called as price elasticity. Then we have an income elasticity, which is when we study the degree of responsiveness of quantity demanded change with respect to the change in income. And sometimes we see the degree of change of one product with the another product. This is called cross elasticity of demand. They have their behaviors, like we have unitary elasticity, we have the inelastic elasticity, we have two main concepts into elastic and inelastic into it. Then shortly we are going to discuss the same elasticity for the supply. We have the price elasticity of the supply, in which we are going to discuss the degree of change in quantity supplied with respect to the price. Then we have a income elasticity of supply, in which we are going to see the degree of responsiveness of change in quantity supplied with respect to the income. And same way we can see the cross elasticity of supply by looking to one change in one product with the another product. Then we are going to see the government impacts on the market. Market is always having some concept in terms of planned economy, in terms of open economy. So in an economy where government is influencing the prices, they have the two options. Sometimes they can fix the price below equilibrium. It is going to create a shortage in the market because more people will be interested to buy. And sometimes government, if they want to reduce the demand, they fix the prices above the equilibrium, which will create a negative impact and it will demoralize the buyers for that particular products. So adding ourselves in product profits, we will see the average profit, total profit, and then average cost, fixed cost, variable cost, and its economic behavior. And then we will straight away go for a market structure based on the behavior. If a market is controlled and owned by one person, then it will be called as monopoly, and monopoly has its own advantages and disadvantages. We will discuss different curves, and we will see the impacts of monopoly over the demand and supply forces, and in particular cases where with the countries or the economies have natural monopolies, what are the impacts on the other markets. Obviously, when we extend, there is a perfect competition in which buyers and sellers has adequate knowledge of the market. They are well aware, and products are homogeneous, and it's a great advertisement around. So we will see the advantages and disadvantages. Then we have a monopolistic competition, and we have cluster oligopoly, and in which we will discuss the cartels. Heading ourselves we have to calculate the national income. In national income, we have different methods. We have expenditure method, we have income method, and output method. We will discuss this expenditure approach. We will take all the expense of an economy. On the opposite, we have another method that we will take all the income of the economy, and we will see we will achieve to a national income level. Then we have to discuss the business cycle. Business cycles, every business has a different cycle. We have recessions, we have boom, we have growth, we have decline. So what are the each cycle implications we are going to discuss in this lecture. Then we have to discuss the inflation. Inflation is when too much money chases few goods, inflation is of course the generalized and persistence increase in the price level, and it has different behavior. Sometimes abnormally prices goes up, then we call as hyperinflation. Then we have steeping inflation. Then we have deflation, that is opposite of the inflation. We will discuss the causes of inflation, which is generally the cost push and demand pull, and there is also a school of thought which very much believe that this inflation this inflation happens because of the money supply in the economy. When the cost of production is going to high, it is certainly going to increase the value. This is cost push inflation. When the economy is growing and the demand level of the economy is increasing, so it is also going to increase the price. This is going to have demand pull inflation. And if the central bank is playing with the supply and demand of the money, surely it is also going to affect the inflation. We will discuss all in detail. Then we have to discuss the unemployment. Every economy has some core characteristics in which inflation is also important, along with the unemployment. Any economy in which unemployment and inflation exist both, this is a stagflation situation, which is we show it through Philip curve. We have to discuss the certain phases of unemployment, like the frictional unemployment, cyclical unemployment, and seasonal unemployment, and industrial unemployment. Then we will discuss the fiscal policy, which is made by the government to run the show of the country. It shows the expenses, and it is followed by the budget. Budget has expenses and income. If your expenses are more than your income, you are in budget deficit. Otherwise, if your budgeted income is more than your expenses, then you are in budget surplus. This we will discuss in detail. And then we'll talk about consumption, investment, government. Then we will discuss about taxes, and then we will see the overall creation of the money. that how money makes money, and we will discuss the monetary policies, which is more related to the supply and demand of the money and issuance of the currency notes, and setting the interest rates in the country, which is surely going to affect the growth level of the economy as a whole. If the central bank is targeting economic development, surely they are going to have a low interest rate, and then they are going to target the more employment, more demand will be generated. But obviously, opposite to this, if the central bank is hoping for or try to control the growth, and they are focusing on stability, then the interest rate structure will be different, and this is how the central bank controls the economy or economic situation of the country. And this we will discuss the trade barriers. Every country has the political or economical ties with the other countries, and based on their ties they have their own trade agreements, and this will facilitate the import and export structure. And but as a bottom line, every country focuses to increase its export and decrease its imports, so can they have the balance of payment surplus. Because if your imports are more, your export is less, then you are in balance of payment deficit, which is not good for the country, and it is going to depict a bad impact on the overall economy. Then we are going to see the currency exchange rates, how it is settled. We have a floating exchange rate, we have a fixed exchange rate.